Welcome to another episode of Talkin Shop. I have my good friend Ryan Kirlin from Alpha Architect here, my other real good friend Andrew Miller from Miller Financial, and we are in my basement, my new home gym. Moved it from the garage down here so we can work out while there's 4 inches of snow on the ground and not freeze ourselves. Knocked out some squats and some deadlifts. And through that process, we had a conversation about ETFs and mutual funds, and then we even kind of tied in some brand recognition and the value of a brand. It was a good conversation I wanted to recreate for everybody since they weren't here with us, putting in work, getting stronger, and staying in shape. So these can bring them to conversation. Just to revisit a conversation you and I had a year ago, You joined me for a workout, and we talked about ETFs. So if you don't know Ryan is at Alpha Architect, an ETF company. They create their own ETFs, an asset manager. Wes Gray, Jack Bogle, you know those names. That's the Alpha Architect guys. And they're crazy workout guys as well. You can't see this flex. I'll try to get it in there. But Ryan came to my house wearing a Leadville Trail, which is a 100-mile race. And he'll tell you he didn't finish, but he missed the cutoff by a minute. He still did some crazy amount. So anyways, let's get to the conversation at hand. So we initially talked about ETFs versus mutual funds. And a lot of financial advisors have grown up with mutual funds. That's all they know. We know ETFs are on the rise, but I don't know what the asset breakdown is. They're still small relative to mutual funds, right?
Yeah.
So
quarter of the size.
Yeah. So I think that's going to be the future. And now that we have commission-free ETFs, we have fractional trading coming.
Yeah.
What's the point of a mutual fund anymore?
Yeah, mutual. I always want to talk for ETFs maybe a little bit, but there are advantages to mutual funds. I'm sure Miller knows. Like one of the biggest advantages to mutual funds that they have over ETFs is you can't close down a mutual fund, right? So if you have some small strategy that has a really constrained capacity, well, you probably can't really do that in ETF. If you were trying to invest in micro caps or something like that. So that's probably a good strategy to have in a mutual fund, right?
Yep.
Advantages to ETF. I mean, the biggest ones probably tax efficiency, but also transparency. You know what's going on. You know what's being owned in the fund.
What about ETFs now? I think the SEC approved 4 fund companies to do non-transparent ETFs.
Yep.
Like, what do you think the trend is with that?
I'm oddly, I think more bullish on that than most people for one reason that's that I think just because the fund companies who have felt locked out of the ETF industry, right? Some of these behemoth mutual fund companies, they may think they have an edge with the non-transparent structure and therefore devote resources and sales and all that to that structure where they've been weary to devote it to the ETF structure. But at the same time, it's a totally new structure, and every single one of those, all 4, there's actually I think 7 different structures. They're all different structures trying to achieve the same goal, non-transparent active, but they are different structures, and therefore it's just going to take time to see how well it works, right? And so I wouldn't want to dive head first as an investor, be the first one to trying out a new structure.
So thinking of what you talked about last year on the ETFs, we talked about the tax advantages of ETFs, the transparency you just mentioned. I would say as an advisor, the reason that I still use funds was being able to save in them regularly in dollar cost average. $100 a month can easily go in rather than having to figure out how many shares. And there's technology that allows us, like I reval with TD, I can actually, if somebody has $500 in, it'll go through and invest most of it based off of the share. So you can still do it with ETFs, but it's very easy and clean to just set up a monthly periodic investment to a mutual fund and let it go and then run a rebalance. But fractional share investing is coming, which kind of makes that not an advantage anymore.
Yep.
Mutual funds tend to be more expensive than ETFs.
Yep.
You're getting actively managed ETFs, so you can't argue that mutual funds are the only platform to be able to have active management. I don't see, other than embedded gains in mutual funds that people don't want to realize, like why would an advisor use a mutual fund going forward? Andrew?
I think there are a couple of reasons. One is for more esoteric strategies, things that use futures contracts where they have to pay out gains on a yearly basis. There's going to be no difference between an ETF and a mutual fund as far as tax treatment.
Yeah.
Second reason would be daily liquidity. or clearing overnight. Sometimes as an advisor, you occasionally get the email or call of, hey, I'm closing on a piece of real estate and I'm closing in like a day or two and I need cash cleared. Oftentimes it's easier to generate cash on short notice with mutual fund because they clear in a day as opposed to 2 days now with ETFs.
Do you think that the clearing will ever speed up for ETFs?
I hope so. I don't know why they can't be pari passu.
I'm not going to comment on that. I don't have a view.
Well, I mean, if they went from 3 days to 2, like why couldn't they go from 2 to 1?
Yeah. I don't know the inner workings of the clearing process, but I don't know why it can't be a day. But that would be one reason is just you can have withdrawal cash much faster with mutual fund.
That's a good point. So you could almost, in theory, like basically build your portfolio with the ETF structure and then have like 1 or 2 at most bond short-term cash holdings. That's where you load for those emergency needs and everything else stays in the ETF. Other than expenses, if you think about everything inside of a qualified account, because for most people, the majority of their assets lie in a qualified account. Their 401k rolls over to an IRA. That and their house are their largest assets. If you look at the landscape of the U.S., then it becomes this cost. So if ETFs are lower cost, that would be another advantage. You lose the tax advantage pro for ETFs, but it's still cheaper than a mutual fund.
Yeah, but I mean, and that's why I think more than cost, more than anything, the biggest advantage of ETFs is the culture. And that's where mutual funds lose. Mutual funds, for the most part, right, they had 60 years where they were king. And for the most part, listen, there's examples. Vanguard obviously didn't do this, but they kept charging you $125, $150. They didn't pass along that benefit of scale to investors, right? As ETFs have. ETFs have come down every year if you look at the industry on the whole, because that's the culture to pass along the price to the end, the benefits of scale to the end investor. Mutual fund industry didn't do that. So they shot themselves in the foot. Investors don't trust them because of that on the whole, right? So I know there's good actors out there, so I think the culture is the biggest advantage why even in a qualified account you would invest in ETFs over mutual funds.
You're gonna crash our video? Come here. You can say hi to everybody. No? Okay. So do you have any other pros, cons, negatives, or anything for mutual funds from your standpoint? There's still mutual funds out there that are charging 5% up front. The A-share mutual fund still exists. And we can speak from experience that most investors don't hold funds long enough to make up that fee. You can make the argument that if you paid your 5% up front, didn't work with an advisor, and I would say an advisor who's not doing planning and other services, so just an investment advisor, you'd probably be better off over 20 years paying your 5% and going. But most investors don't do that. So there are funds that are not only more internally expensive, but they have the higher cost structure on the front end. What other comments or thoughts do you have when it comes to mutual fund versus ETF?
Not a whole lot. To me, it's about what they own, what they charge, the strategy, and the cost. And the ETF versus mutual fund outside of the clearing process is just a wrapper to hold investments, and so largely indifferent. We own bond funds and mutual fund and ETF form similar investment strategy. It's
Let's hit that real quick, because that's one argument I had always heard was that it was better. I think we talked about it last time, but let's refresh everybody. I had heard it's better to own a bond fund than a bond ETF, and I think I don't know if it was liquidity reasons. I can't remember why. So, but is that a valid argument, or is that just something that a mutual fund company came up with?
I think for the most part, that's not a valid argument. There's a lot of and I don't have any bond ETFs, so I think I'm pretty unbiased in this. But anytime I've dug far enough into any of the arguments they would use, like liquidity, things like that, I've often found the ETF wrapper is either comparable or better for bond funds.
Okay.
Argue that.
No, not really. As a matter of fact, when it comes to municipal bond funds, arguably ETFs would be a better format anyways, because they tend to be fairly small, but you'll notice that muni bond mutual funds often have small capital gain distributions.
Mhm.
Some of that's just simply due to the structure of the municipal bond market, that they tend to have a lot of roll down return because it's pretty steep, and roll down is equal to capital gains. So it's a real mild benefit, but arguably you could use municipal bond ETFs and really on the margin improve the tax efficiency of the portfolio.
Right. I agree.
All right, well then, real quick before Silas loses it, ruins this video. We're too deep to start over. This is what happens when you record at your house. You have a 2-year-old come in and make a lot of noise. So I'll edit that out. But the other conversation, you mentioned culture of the ETFs, and I think that ties into brand as well, because I think culture and brand can be aligned. Brand is more company-specific. Culture is kind of industry-specific. But we were talking about the article that Kitts has shared in a recent link fest that he has that showed that investors and advisors are staying with the funds that might be a little bit more expensive because of the brand, meaning they're not bailing on funds of larger companies like the Vanguards of the world to go to the zero or we'll pay you ETF structure. And we were talking about how valuable brand is, and that's something that's near and dear to my heart as I think about advisors having personal brands and telling their story, differentiating ourselves. What are your thoughts on brand recognition and brand strength when it comes to funds?
Yeah, I said the cost war is over, which people, some people get a little perturbed when I say that. Oh no, fees are still going down, right? Yeah, fees are going to keep going down. But the point I use is Vanguard is no longer the lowest cost fund on the ETF side of things in any of the major categories, asset classes. And yet flows still continue to pile into that, right? Why? Right? JP Morgan has a 2-bit fund out there. There's other 2-bit funds out there, 3-bit funds. But people invest in Vanguard because the brand they trust, right? And they're not about to jump ship from Vanguard at 4 bips to JP Morgan at 2 bips because they've known Vanguard for 40 years, has done as best as they could to do what's best for the investors, the owners of their firm. So the brand has trust, and so we're now reaching a point now where people, I think, are putting more trust in the brand of the ETF companies than worrying about fees and other things like that. So that's great because now we can start to figure out, hey, what's the index methodology? What's the cost of this fund? And look at the whole picture rather than just trying to get the, what's the lowest cost in this asset.
Ryan, do you want to talk a little bit about kind of when it comes down to basis expense ratios and fund fees?
You guys keep talking. I'll be right back.
Some of the other hidden or implicit costs in ETFs that an investor can pay and kind of help people evaluate how they might kind of underwrite the all-in cost of a hold-in versus just the explicit expense ratio.
Yeah, I mean, the other big cost, right? The cost for an ETF is the cost you see, the expense ratio, right? But then there's also trading costs. How much does it cost you to get into the fund, and potentially how much does it cost you to get out? So we call that the spread, and that is different. Every fund, every asset class, every issuer, can have wider spreads or smaller spreads, but that's also a fee you don't see. That's probably the biggest one.
Share thoughts on kind of index recomposition and front running some of the trading of index but non-passive indices, and kind of some of the larger they are, perhaps the more incentive there is to front run index reconstitution, kind of some invisible costs in actually running an index portfolio, like example being Russell 2000 and trading ahead of its rebalancing. I've heard rumors that some large ETFs that may have a lowercase first initial have some front running problems in their indices.
There could be. That's above my pay grade. It's possible, but yeah, I wouldn't speculate on it. I don't have enough data.
This is the dude that didn't want to do the video.
Yeah,
I step out to go take care of Silas for a second, and I come back, and he's stealing my show.
Yeah,
like running it like this is his thing.
Yeah.
I love it.
Asking tough questions.
I love it, and I could tell Ryan was uncomfortable. What are you asking me? I love it.
Yeah.
So I missed the final. Are we done with brand?
Yeah.
I missed
Yeah,
that.
now we're talking implicit fund costs. If there's an opportunity to front run fund reconstitution, I mean there definitely have been examples of that that are fairly widely known. But yeah, I mean I don't think that's something I would focus on much as an investor, right? Like I mean because once we hit that point, we are so far down the rabbit hole, right? Like if we're saying we start at, are you investing in your 401k? Are you saving more than you're spending? And that's the starting point.
Who sounds like the CFP?
Yeah. And now if we're now debating if there's maybe a basis point here or there being shaved by front running, like, I don't know. I don't know if there is. So, most firms obviously do everything in their power to avoid that. Yeah. Sounds
good. I think that was a very nerdy, geeky conversation on ETFs and mutual funds. I appreciate it.
Sure.
The whole reason to bring in the brand part, though, is that this channel now, the Talkin Shop and the Advisor Tomorrow is for advisors. So I kind of told you that we mentioned earlier that a lot of advisors still aren't comfortable with ETFs. So we need to learn more and more about it because bullish or bearish on ETFs going forward. Right?
Sure. Yeah.
You have to say bullish. I'm bullish.
I'm very bullish.
So ETFs aren't going anywhere. They're not going to be the demise of the financial system. That was somebody I worked for in the past. Like she was against ETFs. They're going to blow up and cause a big problem. Like that's been proven that that's not going to be the case. So advisors need to get comfortable with ETFs and understand all of this. And as the differential for mutual funds begins to go away because of what we talked about today, you better understand it. The reason to bring brand in is just to show the value of creating and identifying who you are as an advisor, telling your story, creating that of your own brand so that through the brand process, you're going to create stronger relationships with your clients. The communication, everything that you're doing, and being an expert in your area. Yeah. But that's also going to keep your advisors from shopping around, just like Vanguard investors aren't shopping around, even though they might be able to save a few basis points. So, I preach about having a brand and creating it, and we can see it all over. And this is just another example when we talk about the fund company. So, any closing thoughts? I appreciate you guys putting up with the distraction of Silas. You're very good. Any closing thoughts for today's convo?
I mean, on the idea of brand, I mean, I'm out here in Indianapolis. I was talking to Isaiah Douglas, who's focusing on dentists and veterinarians. And it's just kind of amazing because I know he's focusing on that. I haven't, sent anybody to him, but anytime I meet somebody who's like a dentist or a veterinarian, like I'm like, I wonder if I know a guy who, if they need a financial advisor, like I know a guy to introduce them to. So by carving his brand out like that, he's made me like easier to give referrals to him, right? So I think that shows kind of the power of a brand. Yeah.
And you don't have to have a brand of a niche like that. Right, that obviously makes it very helpful. Yeah. But you can also have a brand of being
the tax guy.
Yeah, very complex, sophisticated investment planning, portfolio management, financial planning, like you guys do. I joke that after I get done talking to you, I feel like I'm like in kindergarten as being a financial advisor. And different clients, different needs. Like my clients you would never work with my clients because you really couldn't do all that you like. They don't need everything that you do, which is fine. Different stages of life, different needs. But your brand, Miller Financial, would be very sophisticated, complex situations, business owners, doctors, because you're advising on a per seat revenue type of stuff that I just think is amazing. I'm like, man. So I think that your brand could be niche specific, but it could also be high level of service and planning expertise that could apply to different professions, and it's more of kind of situational. But you find yourself with a lot of docs and stuff like that. So, awesome. Well, appreciate you guys. I know your wife is at home making a lovely dinner for you, so I'm going to let you guys get home so it doesn't get cold and get you in trouble. But I appreciate you coming over, getting a lift in with me, having this conversation, kind of being all over. But I think this is kind of a fun conversation just to hit on a bunch of stuff. So, Ryan, thanks for being a second-time guest on the show. Andrew, thanks for joining me for the first time. Sure. And my goal is to get you on more regularly. Now that we see that you like the camera.
I'll apologize now.
So thanks for tuning in. Be sure to like, share, subscribe, all those good things to get these things circulating so we can spread the word more. Real quick, social media, where can they find you?
At Ryan P. Kirlin on Twitter.
And at Miller AK42.
All right, I will have those in the show notes. Thank you all very much for watching, and we'll see you in the next episode. And there will be no Silas in the next one.